So, this is an interesting time for builders. If you think about sort of your usual behavioral context, you tend to fight the war you just had. And the war we just had was the great financial crisis. That's really what's fresh in people's minds right now. And everybody is concerned that a rise in interest rates is going to cause a complete collapse of the home sector. And the reality is the banks are in a totally different place. Home balance sheets are just, household balance sheets are in a totally different place. And the demand, even though it's probably going to be dampened by these higher interest rates, it's not going to be killed. And we are seeing continued demand even through this slump at places like Lennar. Even in the last earnings release from Lennar, Lennar's CEO basically said that they're still continuing to get very strong demand despite what is happening with interest rates.
You're sounding a little bullish to me.
Well, I'm not going to say, let's temper that. I think that interest rates are going to dampen demand, but I don't think it's going to kill the home builder market the way it did, a few years, the way it did in 2008. And if you think about the lessons learned in that market, a lot of these builders, including Lennar, have taken an asset-light strategy where instead of buying a bunch of land and then holding it until they build the homes, they have just bought land options. Right. And so that sort of asset light strategy really does protect them in a potential downturn. And so the Lennar is still maintaining really big margins, and the supply chain is starting to open up, which expands those margins more. And so that just means that if you're holding this stock, the earnings actually don't have to get clobbered.
Right. And so, OK, Lennar might be kind of your place to go in the space. But yeah, I would add, as you said, the asset-light strategy protects them, but so too do these valuations. When Lennar's trading at 4.5 times, even if earnings fall 50 or 80%, their multiple can't be much higher than its historical average.
You're absolutely right. I mean, these stocks are cheap, cheap, cheap. And that is because if you look historically, again, people are fighting the war that they had. So they're saying, oh, we're going to dump every home builder and anything to do with home building. And we have seen just cheap valuations across the sector with these guys basically at pennies. So I completely agree with you that valuations could get clobbered and they would probably still be okay. But they still have 18% margins. I mean, there's plenty of room there.
All right, let's leave the builders, turn now to those at the center of the mortgage malaise that's been the lenders. The pure plays like Rocket and Loan Depot down, nearly 90% from their highs, tracking refinancing activity almost perfectly. Refi levels are down nearly 80% from a year ago. Would you want exposure here? I mean, there are some who claim they are better protected because they do more of the servicing piece of the business. What do you say?
Well, there's definitely that we've had that conversation about the mortgage servicing and the degree to which that kind of matters as people have to refinance, which this is that time that if you are stuck with a mortgage that is about to reset, you're going to get a lot of refinancing activity off of that. We're playing Bank of America. We're playing a more diversified play, partially because Bank of America is in the business of lending to all sorts of products, not just mortgages, but also they really are very sensitive to these higher mortgage rates. So their income actually goes up as interest rates go up, and they have this really stable deposit base that is not nearly as interest rate sensitive. So that basically says that as interest rates go up, Bank of America starts to make some money. And that's the play that we've decided to go with.
Right. So sticking with the bigger guys, they have more levers to pull and not having to make a big bet on some of the smaller lenders and servicers. OK, so that's the story with the builders and the lenders. Let's turn to the suppliers now, where, again, you could paint a very different story if you wanted to. Home Depot, Lowe's, Sherwin-Williams, yes, they're down 30% this year. They also have inflation and labor shortages to contend with. But if they have a multi-year tailwind from the recent flurry of home buying, you'd have to think that could help them weather the storm.
Absolutely. And you have to believe that, by the way, which we do. We do believe that we're going to have continued home buying, even going into this slowdown. Lido Advisors holds Home Depot, and we believe that it is a good value right now relative to its outlook. And if you believe that home buying is not going away, then you will naturally have to make adjustments. And quite frankly, even if you think that home buying is going away, it does mean that you're staying in an older home, and you're still going to Home Depot. So both sides of that story actually favor exposure to this particular sector.
All right. And rates from here, I mean, would any of this narrative change for you if they're down significantly? Obviously, that helps. But even if they go up from here?
I think that interest rates right now are the tail that's wagging the dog, in that, the inflation that we're experiencing is coming from commodities. So will interest rates really do anything about that? Probably not. And so if interest rates push us into a recession, I actually think that we could see the Fed kind of stepping back toward the end of the year and saying, well, maybe that was too much. So I don't necessarily see this sort of prolonged, very high interest rate experience. We were already seeing the mortgage, we're seeing the 30-year fixed mortgage rates starting to sort of, crumble. You said it was going back up, but it was coming back down,
right,
meaning that it's not quite sure where it's going at this point.
Right, which is true for, true for a lot of investors and for the market.